Welcome back to this video series. Here's a quick recap of all of the videos in the series thus far. Using the existing fact pattern, in this video we will now be journalizing PPE. To journalize means to recognize. Here is a quick recap of the question. If you haven't done so, please revisit part 3 of the series where we read and interpret this fact pattern. Part B. Journalize all transactions relating to plant only, including the relevant deferred tax entries for the year ending 31 December 06. When journalizing, please be super specific. You need to clearly mention whether your debit or credit touches profit or loss or your statement of financial position. Bear in mind that we journalize movements and not balances. As we've already done the heavy duty work in terms of deriving your deferred tax balances, you can now easily obtain your journal entries from the table on the screen. Take a moment to pause this video and identify which numbers you feel will need to be journalized. So first things first, we will ignore the DHC column since our depreciable historic cost is not journalized or recognized. It is purely used for disclosure purposes, so we ignore this column. We also ignore our temporary differences, our rate, as well as our tax base column. What you see in your red box are your entries that we will focus on. To make life simpler, I've highlighted all of the amounts that need to be journalized. For the light yellow, we will journalize it individually. For the dark orange, these items we shall aggregate when journalizing. Journal entry number 1. The first item that you will journalize is your rate change, your deferred tax rate change. So the 2,500 will hit your deferred tax statement of financial position and you will credit your tax expense. Bear in mind that your liability is going from 17,500 to 15,000. Since your deferred tax liability is getting smaller, you will debit deferred tax statement of financial position and you will credit tax expense, profit or loss. Remember to put a suitable narration on all of your journal entries. So this is journal entry number 1. What's next? Journal entry number 2. So the question did tell you that the company intends to keep the plant and has adopted the revaluation model, accounting for the revaluation on the net replacement value basis. So what you basically need to bear in mind is that for the net replacement value basis, before you account for any revaluation, you need to go and take whatever balance is sitting in your accumulated depreciation account and simply transfer that balance to your cost account before you account for the revaluation surplus. Thus, your entry would be debit accumulated depreciation 200,000 and credit your cost of 200,000. set-off of accumulated depreciation, net replacement value method. The next step is to account for the actual revaluation. To do this, you debit your planned cost statement of financial position by 120,000. You credit revaluation surplus, other comprehensive income by 84,000, and you credit deferred tax, other comprehensive income of 36,000. Bear in mind, since your revaluation surplus is in OCI, the tax effect will follow wherever your movement goes. So if your movement goes to profit or loss, your deferred tax would hit profit or loss. If your movement goes to OCI, your deferred tax would hit OCI. The next entry is to account for your depreciation. So this is a simple one. Debit depreciation, profit or loss 70,000, credit accumulated depreciation, plant of 70,000. Your next entry is to account for your reval surplus transfer from reval surplus to retained earnings. If you're unfamiliar with the calculations in the reval surplus column, please refer to part 5 of the video series. To journalize the 14,000, you will simply debit revaluation surplus 14,000 and you will credit retained earnings. So bear in mind that your reval surplus of 84 is an equity balance. It's a credit balance. So your credit is getting smaller from 84,000 to 70,000. So thus you would debit your reval surplus. We then need to account for your disposal. Since the disposal is a little bit of a tricky journal to perform, I've dedicated the next video in the series, part 9, purely to the disposal, where I take you through to the complex mechanics surrounding it. So we're going to skip the disposal journal for now in this video, but I promise it will be covered in the next video. The next journal that we account for is our movement in our reval surplus due to the disposal. So this is simply following the same mechanics of the 14,000 above the 28. You would simply debit reval surplus and credit your retained earnings. In the next entry, we need to account for our addition. Since the question was silent on how our PPE was acquired, we will credit bank/creditors and we will debit cost. The next entry is to account for your depreciation. So in this solution, we are segregating the way how we account for our depreciation, even though the debit and credit for both the depreciation of the old and the new is exactly the same, but we will just keep it separate, in case we get one wrong, thus we don't lose out on any easy marks in the process. For depreciation, you debit depreciation, profit or loss, and you credit accumulated depreciation, planned statements of financial position. Our next entry involves accounting for depreciation of the new on 18,000. The next entry involves accounting for the movement in our reval surplus. So here again, you would debit revaluation surplus and credit retained earnings 8,400. The next part is to account for our deferred tax movements during the year ending 31 December 06. To do this, I've summed up the orange cells, so the items in dark orange, you need to firstly sum it up because it doesn't make sense accounting for each of these entries separately. So you sum 2250 plus 19500 plus 1350 minus 2100 to give you your journal. The other option is to simply take your opening of 51,000 and subtract your closing of 30,000. Bear in mind that you're crediting deferred tax profit or loss of 21,000 and none of these entries over here hit OCI. The only entry that hit OCI was your 36,000. Your deferred tax pertaining to depreciation, pertaining to disposals, pertaining to your depreciation of your old and new, all of them appear in profit or loss. Thus, your tax effect and your tax impact will be in profit or loss. I hope that you've enjoyed this video. Please like and subscribe for more.